We got GDP this morning, Q1 first look. A little slower than expected. One of the things I had been hypothesizing was that I can't see where more growth could come from. We're at full employment. And if you don't add any more new individuals on a large scale basis to the employment rolls of the country, how do personal incomes grow, which drive expenditures, which drive, of course, revenues for companies? So we are starting to see some moderation there with growth. GDP shows us this. At the same time, price pressures, not exactly beautiful. We get PCE tomorrow morning. Bureau of Economic Analysis will release that as well. It's the same government agency. This one is the one that the Federal Reserve is going to be looking at intently as to determine what's going to happen with interest rates. Now, and I've said this a few times, I don't think they're going to do anything but just sit there and pound their chest. The reason is simple. 6 months from now, we have a presidential election. The Federal Reserve is not going to want to do anything that could potentially be viewed as swaying the election one way or another. Okay, so what does that mean? A whole bunch of chest pounding. During a period when we're probably seeing some economic growth slowing down somewhat, price pressures will do the same. So over the course of the next 6 months, we're likely to see the U.S. 10-year Treasury yield pushing a little bit higher, maybe pushing up to 5%, probably no more than 5.25. Given that, the stock market will have to adjust. But after that, we'll probably see the price pressures we're looking for. Then the Federal Reserve can go ahead and start its process of lowering interest rates and accommodating the economy moving forward. So we probably won't see as much growth rates going forward, which means contraction, which means lower revenues and lower profits and lower stocks. There's a lot more to that. Let's jump in. I want to show you a couple of charts that I'm looking at. First look at Reuters put out a nice little article here. If you hit the pause button, the very bottom there, last little bit there, talking about overblown with concerns about inflation being too high, yet no growth, aka stagflation. I don't see it happening. I see growth dissipating because, and I've said this many times, I just don't see where growth comes from, which the big driver, of course, is the consumer. Personal incomes, you put more and more people on payrolls, they, of course, drive expenditures, which, of course, drives revenues, profits, stock prices. Where do we get that more growth? We're at what, 3.825, 3.815% unemployment rate. We get that coming in next Friday, and we'll get another look at that. I expect we'll probably start to see some slowing there. Regardless, at 3.8%, that is nearly completely full employment. This is transitory employment. Individuals who are in between jobs that are actually looking. We looking at non-farm payrolls themselves, the whole number, we've never all-time highs, plain and simple. We have more people working now than ever before, and the unemployment rate is exceptionally low. So where do we get more growth? That's what it boils down to. And without that growth, without more growth in personal incomes and expenditures, price pressures start to dissipate. At the same time, we're seeing interest rates moving slightly higher. This is affecting the 30-year mortgage, which would affect housing. That, of course, 70% of the inflation we had previous, that big spike up, housing. So the Federal Reserve being forced to sit on their hands and probably do not much of anything because of the pending November 5th presidential election, which they have a 2-day meeting on the 6th and 7th. That's 6 months. That might be, if they just sit on their hands, that might be enough. Inflation probably going to start to dissipate a little bit more. We'll probably see some movement upward, but given where we are right now, interest rates pop up a little bit further, sit there for a little bit, and then we start to see the information we need where the economy is starting to contract somewhat, employment is starting to drop, and because of that, inflation moves a little bit lower, interest rates move lower, equities start moving back upward. Here's a look at gross domestic product and personal incomes. GDP is the green bar here, and blue is personal incomes. And I overlap this simply to show you that there is a very strong correlation that the consumer drives the rate of growth, the change, year over year change. As more and more people enter onto the payrolls, they get their paychecks, they start getting paid, they start spending money. People get raises, expenditures increase. That drives the economy overall. And you can see the correlation here between GDP and, of course, personal incomes. And this is something I wanted to kind of overlay these. We are seeing personal incomes, the blue chart, moving higher. Despite gross domestic product moving lower, it's moving lower from a very high point. That's something to really kind of be looking at. So these people that are sitting there saying, oh, stagflation, there's no growth, but we have inflation. Man, we're above 5% on GDP. That's growth. All right, moving forward, I put together, it is now, what is it, just about 10:15 after the hour, 2 o'clock my time here in Santa Fe, New Mexico. I'm 2 hours behind New York. Alphabet, parent company to Google, just reported first ever dividend, and of course earnings beat, and look what happened with the S&P 500 right at that time. Perfect. Given that, you can see the initial sell-off from GDP at 0630 my time, and I was up. I was watching the charts. It initially popped up, and I was watching S&P 500, not the 10-year Treasury, because I wasn't quite sure. What happens is individuals will hear that first number, the market will move. Then they start looking underneath the hood to ask the question, well, okay, that's great. What else is there? The S&P 500 sold off, all the equities sold off, but then rebounded to end positive for the day. And of course, Alphabet just shot everything up. You can see the numbers there. 1400 is 2 o'clock my time, 2 hours behind New York. I use military time. I'm a veteran. But when I saw the GDP numbers, I thought, well, it's not bad. Actually, it should kind of turn around. I don't understand why it's going down. But the 10-year Treasury yield, of course, went higher, and that was really kind of what people were focused on. Here we're looking at the U.S. 10-year Treasury yield. This is the benchmark. You got the monthlies, you got the 2-year, the 10, 20, and 30. I defer mostly when it comes to my analysis to the 10-year simply because it's a good gap between the 2 and the 20 or 30. And it's the benchmark investment rate. We're at 4.7%. As you can see over the past couple months, we've been moving higher and higher. And I expect we'll probably challenge 5%. I don't know that we're necessarily going to get up that high. But I also expect we'll probably hang out there for a while with the 10. Not necessarily going higher because I believe the Federal Reserve is pretty close to where they need to be. And just merely talking interest rates higher might be enough, while at the same time growth rates are declining. That might be enough to get us to where we need to go. How much damage will there be with equities in the meantime? Well, at 4.7%, ask yourself a question. If you're sitting on some equities that you are questioning that might be overpriced, NVIDIA, NVDA stock, the yield on that the next 4 quarters, you're looking at 2.5%, 2.25%, versus the 10-year Treasury yield. If you bought this today, you'd lock in 4.7%, which is more than double what you would get with NVIDIA. What's the downside risk for investing in treasuries right now? Well, for 10 years, you're locking in 4.7%. But what could happen is the Federal Reserve quickly turns things around and lowers interest rates. And if they lowered interest rates down to, say, 3.5%, your bonds you're sitting on for 4.7% are looking really attractive. So your downside risk is fairly limited. NVIDIA, yeah, of course, AI is going to be something pretty huge. But they're only yielding 2.2%. And what's happened is companies have chased yield too far. NVIDIA is trading with only 2.25% yield given the next 4 quarters. Of course, there's growth there. But you're only getting 2.25%, and it's going to take a couple years to get all that growth. In the meantime, there's too much risk. NVIDIA's stock will come down. I just did a video on Meta platforms. Meta, of course, just releasing their earnings, did very well. As it turns out, yield on Meta is at this price right at par with the U.S. 10-year Treasury. So what's the risk there? The risk is that the entire economy does contract somewhat, just a little bit, which would be enough to make Meta Platforms META stock overpriced. One of the reasons why Meta came down. One of the reasons. There are a few others. I did a whole video on Meta. Make sure to check that one out. Here's a bigger look at U.S. 10-year Treasury yields going all the way back to 2020. You can see that the 10-year has just continually been moving higher and higher. And this is the story. As inflation has grown, interest rates need to pop up, but there is a top side, and we're getting close. And that's really kind of the focus that you need to be looking at. The big picture tomorrow morning, for those of you not getting this in a timely manner, this will be Friday morning at 08:30 New York. PCE expenditures versus the PCE deflator. Now, we just got some price pressures in the GDP report. They will reflect almost exactly the same thing as the PCE deflator, price deflator. Personal expenditures, if you overlay personal incomes and expenditures, they're pretty close to 1 for 1. This produces price pressures as consumers spend more and more. As the rate of growth of expenditures increases or decreases, so do price pressures. This is a classical example of economics. However, the big reason we've seen a spike is housing. Some of the things that are going on with the housing market is entirely skewed because interest rates were so low for so long. There's people sitting on 3.25, 3.5% mortgage rates. That supply's gone forever as with regards to housing. One of the issues there is you might have a family who needs to upgrade, but they're in a smaller house with a really low mortgage. Or you might have some boomers who are in a really big house with a really low mortgage and don't want to downgrade because of costs, because of the mortgage rates, because they got a fixed for whatever period of time at 3.5%, whereas the current 30 is pushing 7%. So there's some supply issues there. This will, for years, kind of skew the housing market. It's something I continually am keeping an eye on. In the meantime, another look at the S&P 500, a kind of a bigger look. I think we might have peaked for right now. I think we might see a range coming back down from 4,800 to possibly 3,800 for a period of time all through summer. Let's see what happens with inflation. Tomorrow morning we get the PCE price index deflator, and that could be an interesting price. But we did get a good look at GDP, and we pretty much know what we're going to see. The market will probably react with slightly higher interest rates. We basically just saw what we need to see for tomorrow morning's number. In the meantime, with higher inflation and higher interest rates, we've likely seen a peak in the stock market for now, and it might hang out at these upper levels for a period of time before we see a slide lower. But as the 10-year continues higher, your alternative investments to owning stocks, which might have been pushed too high relative to your benchmark investments, those stocks will probably sell off, which will pull the stock market lower. Seeing 4,400 in the S&P 500, that's an easy one for me to kind of see. Dropping below 48, 46, 44 in there, easy. But then once the Federal Reserve is done and the Federal Reserve starts talking about lower interest rates, you'll see growth rates return to employment and expenditures, which translates into growth rates for companies, profits, and higher stock prices. Make sure I have a Substack link down below. For those of you who've been following me for any period of time, I'm getting rid of the website and going straight to Substack. Get the free email newsletter where I break down economics in the stock market. If you're just finding my channel for the very first time and this is the kind of content you're looking for, make sure to hit that like and follow button. Thanks so much for the comments. We'll see you in the next video.